markets here in the City of London, they think that the banks could start cutting rates as soon as the summer, so maybe even June. Some people think even May. And that conversation is now live. I think that's the distinction here. We also got an update of the bank's latest economic forecast. And what was quite interesting there is they think that inflation could go down to its 2% target. So at the moment, about 4%. The target for the Bank of England, they need to keep it to, is 2%. They think inflation could get down to 2% by April this year, so in a few months' time. However, they say it's then going to rise up again, and that's the thing they're concerned about. That's why they're not cutting rates immediately, because they're concerned that inflation is going to rise a little bit more because there's just a lot going on with energy prices right now, and that's kind of feeding through to the inflation numbers. Final thing to note, the economic growth picture. We also get their latest sense of just how well the economy is doing. And actually, there's kind of, broadly speaking, better news there than last time around. They've upgraded their growth forecast for this year, for next year, and for the year afterwards. Excuse the police siren there. City of London, lots going on. They've upgraded their forecast for the future years. But here's the other thing. They say it's more or less a 50-50 chance as to whether the UK records a technical recession towards the end of last year. Remember, there was one quarter, so a technical recession is just when you have 2 quarters where the economy is shrinking. Okay, and there was one quarter where it's shrinking a little bit. We're about to find out in a couple of weeks' time what happens in the final quarter of last year. And the bank thinks it's basically likely to be 0, but it could go either way. So quite a lot going on there. But the broad picture is the official conversation about interest rate cuts. That's now beginning. And it's really a question of not if, but when. So rates still at 5.25%, but they could well be coming down quite soon. And the bank has started to have that conversation. But we're going to hear more from the governor in the coming minutes. And we'll talk to him a little bit later on as well.
OK, Ed, thanks very much. You are watching Sky News Today. Coming up, a shake-up that'll send seismic waves through Formula One. Sky Sports News understands Lewis Hamilton is set to make Ferrari his home in 2025. And Labour unveils its big promises to business, which the Shadow Chancellor says strikes the right balance. 1,000-strong tractor convoy rolls into Brussels. EU farmers protest cheap imports and the rising costs of doing business.
They locked me up for 3.5 years and were prepared to throw away the key. And within a couple of seconds, there were a number of armed security.
An autism patient's dramatic escape from a secure psychiatric care unit sparks a major investigation.
I was petrified.
Follow Patient 11 wherever you get your podcasts.
It's always difficult at this time of year when you walk out on a train station, for example, it's freezing cold and you can't think forward. But we've been there before. A couple of years ago, 40.3 was the top, and everybody else 37, 38. So, look, it's a silent killer. That's what this committee. Simply because when these things are reported, they're not reported you died of when people die of of heat. It's not reported you die of heat. It's reported you die of a stroke or a heart attack or other symptoms that go with hot weather. And hot weather does kill as much as cold weather kills. So weather is massively underestimated. And I'm really glad that this committee have got some. Whether they got teeth is another matter, but at least they brought it to the attention. And also the fact that you are actually reporting it on Sky News, because it's almost like a silent story. It doesn't get out there. It doesn't resonate. I think they've got to put this into schools, colleges, and the broader spectrum of society to make them understand, make people understand that weather per se, whether we're talking storms, we're talking cold, hot, understand that when you see these extremes of temperature, these extremes of weather, that we have to act accordingly. So what we do, I could be here for a day and a half, but the point is we've got to move in that direction. So people have got the knowledge to help themselves first, help their families first. So a really easy one would be, for example, painting roofs white. Why? Because it reflects the heat in the summertime. When you get that excessive heat and you touch a white surface, it's very different than touching a black surface.
We have some breaking Formula One news in a moment, but first, something that may perhaps interest a lot more people. We have the escaped Highland monkey has been caught. Hey, Keith Gilchrist, who works at a Highland Wildlife Park, this is the monkey up in Scotland, and can you see, said, "We can confirm we have successfully caught the macaque that escaped from the park on Sunday. After a call to our hotline just after 10 a.m, our keepers and drone team made their way to a member of the public garden where the monkey was eating from a bird feeder and successfully used a tranquilizer dart to catch him. The monkey is on its way back to the park with our keepers, where he will be looked over by one of our vet team and reintroduced to the sub-adult males within the group. We want to thank everyone who helped with the process and will continue to share any further updates. So this monkey has been on the run in the Highlands for the last few days. He has now been caught and safely returned to the zoo. But the really big breaking sports news is that Sky Sports News understands 7-time Formula One world champion Lewis Hamilton is to join Ferrari for the 2025 season. Our correspondent Daniel Henry has more. Daniel, what do we know?
Well, I think we need to start with the fact that Lewis Hamilton is the most successful Formula One driver of all time. More race wins than anybody else, more podiums than anyone else, more titles, not quite more titles than anybody else. And I think that's actually the driver behind this move. He shares that with Michael Schumacher. They both got 7 world championships, and Lewis Hamilton's hoping to go for 8, and he wants to be out on his own more than anybody else, past or present, and he believes that this move to Ferrari is the best chance for him to do that. There's been some cracks in the relationship between himself and Mercedes recently. Some people will know that Lewis Hamilton hasn't actually won a race, an F1 race, since December 2021, which is extraordinary. And he has put the blame on part of that on Mercedes. The fact that in his view, they're not talking to him about the design of the car. He feels that they haven't consulted him that well when it comes to that. Just last year, he said, "I know what a car needs. I know what a car doesn't need." So he's questioned the team on their car design before, and that, I think, is what's kind of driven him towards Ferrari, where he believes that they will build him a faster car, one where he will have a better chance of being able to take on the likes of Red Bull, who have been so dominant in recent years. So big news for him, big news for everybody. We're expecting more from Toto Wolff, that's exec director of Mercedes. We're expecting to hear from him at some point, and possibly to hear from Sir Lewis. And as soon as we do, we'll bring that to you, Jane.
OK, Daniel, thanks very much. Daniel Henry there. Right, let's get a look at the weather.
Warm memories wherever you go. The weather, sponsored by Qatar Airways.
Mostly fine today before turning rather dull and damp tomorrow. Many places will start the afternoon dry and sunny, but the blustery north will be cloudier with showers for northern Scotland. It'll be a bit colder than yesterday, but light winds in the south mean it'll feel pleasant enough in the sunshine there. Much of Wales and central and southern England will stay sunny throughout, but elsewhere cloud will increase, bringing more general rain across northern Scotland. That rain will clear eastwards overnight, but cloud will spread to most parts, bringing fog and drizzly outbreaks to western hills. The wind will pick up too, but it'll be mild in the west. Friday, mostly cloudy.
The weather, sponsored by Qatar Airways.
You're watching Sky News Today. Coming up, the Bank of England's Governor Andrew Bailey will deliver a news conference following this lunchtime's interest rate decision. take across to the Bank of England and the Governor.
We've had some good news over the past few months. Inflation has fallen a long way, from 10% a year ago to 4% now. Things are moving in the right direction. Today, the MPC has held bank rate at 5.25%. So yes, we have had good news, but we have to be more confident that inflation will fall all the way back to the 2% target and stay there. And we're not yet at a point where we can lower interest rates. So the level of bank rate remains appropriate. Any decision to change bank rate will depend on how the evidence evolves. Price stability is the foundation of a healthy economy, and we must get inflation back to the 2% target sustainably, and we will do that. I'm going to start by describing the outlook for inflation. As chart 1, which is up on the screen now, shows, we expect consumer price inflation to continue to fall over the coming months. That's in the shaded area. It may tick up slightly in January's number, to be published in 2 weeks' time. That's because of so-called base effects from volatility in prices like airfares. But by the time we get to March, we think inflation will be around 3%. And in April, May and June, we expect inflation to be close to the 2% target, before increasing somewhat over the second half of the year. Inflation is coming down primarily because the global inflationary shocks have been abating. The prices of traded goods and food are no longer pushing inflation up as they did, and that's illustrated in this chart by the purple and blue bars. Oil and gas prices have fallen significantly since November, and that pushes further down on headline inflation in the months ahead, as shown by the contributions of energy prices in the dark orange bars. When we raised interest rates, it was not to prevent these global shocks from happening. That wouldn't work. It was to prevent second-round effects on domestic prices from taking hold. Our restrictive monetary policy stance is working to reduce domestic inflationary pressures. Services price inflation, which is closely linked to domestic costs, has started to ease, and somewhat more than we had expected. But services price inflation tends to be persistent, and it remains elevated. And you can see this in the yellow bars in the chart. So it's not as simple as inflation returns to target in the spring and the job is done. Futures prices for oil and gas suggest that we should not expect further big falls in energy prices. So looking further ahead to the second half of the year, the negative contributions from energy prices are likely to fade, absent any further shocks. And in and of itself, that will push headline inflation back up somewhat. The second chart shows just how important this energy component is when we look across the whole year and into next year. The blue line is our baseline projection for headline inflation over the next 3 years, conditional on a path for market interest rates implied by market yields. The red line is a projection for inflation excluding the energy price contributions, which are also shown in the purple bars on the chart. As the negative contributions from energy prices fade away over the second half of the year, headline inflation in blue is set to go up again somewhat to around 2.75% by the end of this year. Inflation then remains around this level throughout next year before gradually returning to target in 2026. Now, this means that inflation is above target for longer in this projection than it was in the November report. But that brings me to an important point. This projection for inflation is not, I should stress, an unconditional forecast. The projection is the modal or most likely path for inflation in the best collective judgment of the MPC, conditional on a set of assumptions about energy prices, the exchange rate, fiscal policy, and market interest rates. So they include market pricing for expectations of future monetary policy decisions. Now that's important because these conditioning paths have changed significantly since our previous projection when we were sitting here back in November. The Brent spot oil price has fallen by 16%. European gas futures prices for this year have fallen by more than 30%. And that pulls the inflation profile down in the near term. At the same time, the market implied path of bank rate on which the projection is conditioned has fallen by almost 1 percentage point on average over the next 3 years, and that pushes the profile for inflation up over the medium term. Now, as Chart 3 shows, the fall in the market path for interest rates has widened the gap between our baseline projection, which is conditional on that market path, and our alternative projection, which is conditional on holding bank rate constant at its current level throughout the forecast horizon. In that alternative projection, inflation is projected to be around the 2% target through the first half of the forecast period, before falling below the target in the second half of the period. In other words, if we were to keep bank rate at 5.25% for the next 3 years, we think it's likely that inflation would eventually fall significantly below target. But if we were to follow the market conditioning path, we think inflation would be above target for much of the next 3 years. And we need to get that balance right. We have to keep monetary policy sufficiently restrictive for sufficiently long, nothing more, nothing less. So that obviously raises the question for how long will a restrictive stance be needed, and what level of bank rate will be required to deliver it. Now, the answers to those questions will ultimately depend on what the incoming data tell us about the outlook for the UK economy and inflation over the medium term, on whether we have enough evidence that policy is sufficiently restrictive to overcome persistence in inflation. Now, there are always risks that can change the outlook. Sadly, geopolitical risks have intensified following events in the Middle East. There has so far been a limited impact on wholesale energy prices, but shipping volumes have fallen materially on Red Sea routes, and as Chart 4 shows, shipping costs have increased on routes from East Asia to the Mediterranean, that's the purple bar line, and Northern Europe, which is the light blue line, albeit not to the same level seen during the pandemic, which you can see obviously on the left-hand side of the chart. And so far, these price increases have not spilled over to other routes, such as from East Asia to the east coast of the US, which is the orange line. And the impact on consumer prices has so far been limited. But that could change if trade disruptions continue. And this poses an upside risk to our inflation projection over the first half of the forecast period. Now, I want to move on to the key judgments that we've made in this forecast. In its assessment of the medium-term outlook, the Monetary Policy Committee has been guided by 3 key forecast judgments. Those judgments are, and the risks around them, are obviously described in the Monetary Policy Report. The first key judgment is that GDP growth is expected to pick up gradually during the forecast period. Higher interest rates are weighing on GDP growth, but with the fall in market rates and because a fall in import prices is boosting real incomes, we expect the economy to pick up a bit more speed. Bank staff estimate that around 2/3 of the peak domestic impact of higher interest rates on the level of GDP has now come through. And that percentage is up from about half in November. The second key judgment is that excess demand is turning into excess supply. While we expect potential supply growth to remain subdued, a modest pickup in productivity and labour supply growth is sufficient for supply to outpace demand over the forecast period. The third key judgment is that second-round effects in domestic prices and wages will take longer to unwind than they did to emerge. And this helps to explain why inflation remains above the 2% target in our baseline projection, despite the emergence of excess supply. In light of recent evidence, the MPC has slightly reduced the effect of this judgment on the degree of persistence in domestic prices in the forecast. But inflation remains above target in the projection also because the fall in market interest rates, on which it is conditioned, has reduced the degree of slack that builds in the economy over the forecast horizon. We turn to the labour market. In making these key judgments, evidence on labour market developments is, of course, important. The MPC considers the collective steer from a wide range of data to inform its view of labour market developments. But continued uncertainties around official data are posing challenges. This is especially the case for the rate of unemployment, where we have fewer alternative indicators to draw on. Judging by the outlook for the economy and consistent with our second key judgment, we expect unemployment to rise somewhat further to around 5% by the end of the forecast period, which is a little above our estimate of the medium-term equilibrium rate. To inform our third key judgment on inflation persistence, the MPC also monitors wage developments very carefully. Now, here we have more to go by. And the official data are now not affected by current issues with the ONS's labour force survey. Annual growth in regular private sector wages fell to 6.5% in the 3 months to November, and that's around 1 percentage point lower than we expected in November. Now, as this chart 5 shows, this has brought the headline wage measure, that's the blue line, into line with other indicators of annual pay growth. Now, as chart 6 shows, the MPC continues to judge that private sector wage growth will ease more slowly than the range of forecasts from our suite of models would predict. I've used this chart before. The suite is the grey swathe in the middle. Though the recent news implies that pay growth is slightly weaker than projected in November, reaching 3% by the end of the forecast period. Combined with the news we have had on services inflation, this is consistent with our third key judgment, namely that second-round effects on domestic prices will take longer to unwind than they did to emerge, if perhaps not quite as long as we previously thought. So let me now turn to monetary policy and the decision. The MPC remains prepared to adjust monetary policy as warranted by economic data. It's the evidence that will drive our decisions on interest rates. We will continue to monitor closely indications of persistent inflationary pressures. As we see the outlook for the economy and inflation today, based on the evidence we've had, we think it is most likely that this year's questions for the MPC are, for how long should we keep bank rate at its current level? And have inflationary pressures eased enough that we can begin to lower bank rate or not? At this meeting, the MPC discussed all options. 2 members of the committee voted to increase bank rate, 1 member voted to cut. The 6 members in the majority were of the view that bank rate should stay at 5.25% and that we need to see more evidence. We will therefore keep under review for how long bank rate should be maintained at its current level. So to conclude, we've come a long way, and that's very good news, but we're not there yet. So with that, Ben, Dave and I will be happy to take questions.
Great. Who'd like to go first? Well, Maureen, we'll start with you and then Faisal.
Hello, Mehreen Khan from The Times. Given that inflation is falling faster than the bank has expected, by keeping rates on hold, you've marginally increased the level of tightening in the economy. How can you justify that given that, according to your own forecast, growth is barely above 0%, there's slack emerging in the economy and inflation is going to be in the 2 to 3% range? So how can you justify not cutting rates and actually increasing the level of tightening that's going to be coming into the economy by keeping rates on hold?
Well, I'm sure Ben will want to come in on this, but I think the key thing to stress, Maureen, is that what we look at is the level of the degree of persistence of inflation. So, as I said earlier, you're right that inflation is now falling faster than we expected, and as I said, we do expect it to come near to target this spring, and that, of course, is very good news. But we don't expect that to be the sustained level. As I said, it's going to rise again somewhat thereafter. And it's really that thereafter period that we are most focused on when setting policy. We do have to look through the short-run impact that energy prices in particular are having. And as I've emphasised, I'll emphasise again, what we need to see is the evidence that the more persistent elements of inflation, I'll point to services inflation there particularly, are going to ease back and allow that move of inflation back to target and for it to be sustained. But you want to...
Yeah, just a couple of small points on the degree of restrictiveness. I mean, first, if you're looking at real interest rates, I think we would tend to think that it's expected rather than actual inflation. It's ex-ante real rates that matter more. So I think the fall in headline inflation is not the thing one should use. The second thing to say about that is that in particular in the mortgage market, but more generally in the private sector economy, it's 2-year interest rates that are probably more important than the overnight rate. And those 2-year interest rates have fallen a lot in the forecast. And as Andrew said in his opening remarks, that's a big reason why the inflation forecast conditional on the market path is actually higher now than it was before. So for those two reasons, I'm not sure it's right to say that the degree of restrictiveness is increasing simply because headline inflation is coming down.
And just to add a little bit of context to Andrew's comment about services inflation, I mean, you're right that headline inflation down at 4% in December, and as Andrew said, that's good news, and it came down further than we were expecting. But within the total, services inflation still at 6.4% in December. Core goods coming down faster at 3.1%. And then energy making a very strong negative contribution, as Andrew said, but services up at 6.4%. That's one of our key indicators of persistence. And we need to see, even when inflation is down at 2% briefly around 2% briefly in the spring, we still think that services inflation is going to be much stickier and quite a bit higher. If you actually look back at that chart that Andrew showed, services inflation more than accounts for the whole of inflation in Q2. So we've still got that persistence.
Faisal.
Thank you. Faisal Islam, BBC News. Can you just clarify, the forecast seems to imply that keeping interest rates where they are would risk a sluggish economy turning into a recession. And can you really justify that to households when inflation is going to hit target? Or do you see that inflation at target in the next coming months as some sort of kind of artifice?
Well, if you're referring, Faisal, to the constant rate forecast as the sort of the alternative, I think it is important to remember how the constant rate forecast works in a sense, because what the constant rate forecast says, it's not about whether we, as we did, take a decision to keep interest rates at their current level this time today. That projection assumes that we keep interest rates at that level forever, effectively, for the horizon. And what that means is that you get obviously all that goes with it. You would, in that assumption, you get a very sudden shift in asset prices because people assume to take that on board. So it's not about saying the effect of not changing interest rates today is to put us on that path. Actually, it's the opposite. I mean, obviously, the market path actually did not assume we would change interest rates today, so they're consistent. The market path is then obviously conditioned on the curve that's in there, which has cuts in rates in it. So I really would sort of caution that it needs to be interpreted in that way.
Can we go to Ed and then Sam, please?
Thank you. Ed Conway from Sky News. Governor, do you think the next move in interest rates will be a cut or a hike, or are you just completely neutral on that at the moment?
Well, I think one thing I would point to is the one change we've made this time is that you will have probably seen that we've removed the language that we had previously in, which had, if you like, a sort of an upside bias to it, which was based on our concerns about persistence in interest rates. And as we were saying a few minutes ago, we've seen a change in that respect. So where we are today is, I would say, and as I said, I set out what I would call those sort of key questions for the MPC. And for me, the key question is moved from how restrictive do we need to be to how long do we need to maintain this position for? That's the key question. Now, what I would recommend is you put those two things I've just said together, if you like. We've taken away the upside bias, and I think the question has moved on to how long do we need to maintain this position for. Now, we are not going to speculate on that. I mean, I think we will be based, as we always are, on the evidence. We go from meeting to meeting, we review exhaustively the evidence at each meeting, and that's the right thing to do, in my view. But I hope that helps, because that's the right framework to see the current situation in my view.
Sam, right here.
Thanks. Sam Fleming from the FT. Let me push you on the same topic. Jay Powell yesterday was able to say that given the positioning of his committee, it was not going to be possible or unlikely to see that they would see a a rate reduction as soon as March. Could you give us a sense of the debate on the MPC and whether that would lead you to a similar conclusion? And second question is just on this whole question of the last mile when it comes to getting inflation down. It's something that policymakers around the world have been talking about a lot recently. Given your message on services prices inflation being sticky, would you say that that is also how you see things, that indeed the last mile, the easy part is over and the last mile remains the trickiest? Sure. Thanks.
Well, I'd start on the first question. Our practice, and I think it's important, we do stick to this, is that I'm not going to speculate on what we do at the next meeting, because we're very clear that we take all the evidence into account. By the way, between now and the next meeting, we will get this is the way our timetable works, we will get two sets of both inflation data and labour market data and quite a few other bits of data as well. So we will have plenty more data to work with by the time we next meet. And I do think it's important in the way our system works is that we reserve judgment on that. We will come back to it. But if I go back to the answer I just gave Ed, within the framework that we've set out, which has changed somewhat, I think that's an important point to make. On the last mile, I'll start. I don't think anything's changed in the sense that we are emphasising this question of persistence, and we're emphasising the same things that we think are important in terms of indicators of that. Now, I think the picture has changed somewhat because inflation has come down very rapidly. If you think about, and I hope this will be the case, how that feeds through into expectations, how that then feeds through into the real economy and into evidence, I hope that will obviously be reflected through into the last mile, as it were. But we need to see more evidence on that, as we've said.
Yeah, I'm not sure it's. I interpret that last mile comment as some absolute thing, that intrinsically getting inflation from, say, 4 to 3 is much easier than getting it from 3 to 2. It's more that the shape of this whole episode, where the effects of these huge rises in import prices have dominated the picture. And we always thought at some point those would ebb away, and that's exactly what's happening and will continue to happen. And that leaves the stickier bit. And so that's the sense in which I would view the last mile. And it's that stickier, more domestic component that we've been focused on throughout.
But just to come back, if I may, to Andrew's point of how expectations will also influence this picture, the fact that headline inflation is coming down and is coming down sharply means that compared to, say, where we were through last year when, even last summer inflation was significantly higher, that worry about whether you were going to get second round effects from inflation becoming embedded in price setting and in wage setting, I think compared to where we were then, we have reduced a bit our persistence judgments that we'd put into the forecast to allow for that. We still have some asymmetry, by which I mean we still think the second round effects will take longer to play out than they did to emerge. But that's why through the forecast and by the end of the forecast, you do see inflation coming back to target.
With Helia and then Joel.
Helia Ibrahimi, Channel 4 News. Governor, cash-strapped homeowners and renters will want to know why you're not acting now. Are you saying that despite the fact that inflation will come down to target in spring, the good news is not that good at all because things are going to get worse again later in the year?
Well, I very much understand the situation that you described for many households. I think it's important to emphasise again that while inflation is, we think, going to come down to target in the spring, that will not be sustained. We think it will go up somewhat, but let me emphasise somewhat. I mean, I want to give two messages here which need to sit together. We need to get inflation down to target and keep it there on a sustained basis. It is going to go up somewhat after the spring. We think, as I said in my opening remarks, possibly 2.75%. This is not back to 10%, let's be clear. That's why I use the word somewhat very advisedly. But it's important. That's not an acceptable state of affairs as a resting place. And so it's important that we do the rest of the work. What we will then see, if we see that evidence emerging, and it goes back to the answer I gave to Ed earlier, within that framework, of course, we will be able to start then to consider taking the decisions on where we move rates. And I'll re-emphasise that framework. We've taken away the upside bias, and I'm very clear that the decision and the question we face now is for how long we have to maintain this stance. And we will not maintain it any longer than we need to do to achieve the objective of inflation being at 2% on a sustained basis. And I'll just finish by making a point I've made many times, but it's a very important one. Of course, having inflation, having price stability, and having inflation at 2% is by far the best thing we can do for households.
Can I just add on mortgage rates, because, and we put this in chart 2.7 on page 38, we are seeing that what we've seen since our November forecast, which is falls in market expectations, that's fed through into the reference rates that Ben was talking about, which are the reference rates for the key.
We're just going to step away from that Bank of England press conference. The Governor, Andrew Bailey, explaining why they have made the decision to keep interest rates at 5.25% today, thinking that inflation could drop to 2% by April, and telling our Ed Conway that they are actively considering for how long they need to maintain interest rates at that level, and that they won't keep it for longer than they need. More reaction to that and all the rest of today's news after this break. Hello, you're watching Sky News Today with me, Jane Secker. It's 1 o'clock. These are the headlines. A significant announcement from the Bank of England as it forecasts inflation could fall to 2% within months.
Price stability is the foundation of a healthy economy. And we must get inflation back to the 2% target sustainably, and we will do that.
The potentially life-changing injuries. CCTV footage emerges after a corrosive substance is thrown in an incident, injuring 9 in South London. Sky Sports News understands that the 7-time Formula One world champion Lewis Hamilton will join Ferrari next year. Farmer protests, fires lit outside the European Parliament in Brussels as tractors roll up in anger. And monkey business over. The Highland Zoo escapee caught on its 4th day on the run. Hello, good afternoon. We start with breaking news. The Bank of England has signalled fresh hope for the UK economy as it forecasts inflation could be down to 2% within months. The Governor, Andrew Bailey, said things are moving in the right direction as the Monetary Policy Committee decided to hold the current interest rate at 5.25% once again. Well, let's take a quick look at the UK's battle against the scale of rising prices over the past few years. Inflation in the UK was 11.1% at its highest in October 2022, hitting a 41-year high. It's currently at 4% as of December 2023. And as we've heard, the Bank of England now forecasts it will drop to 2% by April 2024. This is what the Bank of England governor said in the last half hour.
We've had some good news over the past few months. Inflation has fallen a long way from 10% a year ago to 4% now. Things are moving in the right direction. Today, the MPC has held bank rate at 5.25%. So yes, we have had good news, but we have to be more confident that inflation will fall all the way back to the 2% target and stay there. And we're not yet at a point where we can lower interest rates.
Well, our business presenter Ian King is in the city. So steady as they go, I suppose you could say, about interest rates, but looking positive to the future.
Yes, that's right, Jane. Very, very interesting to note that there was a 3-way voting split on the Monetary Policy Committee, with 6 members voting to keep bank rate at 5.25%, 2 members, Catherine Mann and Jonathan Haskell, voting to raise interest rates, and a 3rd member, Swati Dhingra, voting to cut interest rates. That's significant because that's the first time since the pandemic that an MPC member has actually voted to reduce bank rate. This is also, incidentally, Jane, the first 3-way voting split that we've had of this kind since August 2008 at the height of the financial crisis. So it is quite an unusual outcome to the vote in that respect. What you heard there from the governor was, as you say, reasonably optimistic. They do expect inflation to come down to the bank's target level of 2% within the second quarter of this year, i.e. some point between April, May or June. But it's worth pointing out the Monetary Policy Committee then expects inflation to gradually tick above the bank's target rate in the second half of this year. So not too encouraging on that front. And that's perhaps why the Governor, Andrew Bailey, there was stressing that there is no real rush for the bank to cut interest rates. Interestingly, they also changed their forecast, not terribly encouragingly for this year. The bank was previously looking at modest growth in GDP this year. They now say the economy will flatline, although they have raised their growth forecast for next year and the year after. So in the meantime, they're also expecting that unemployment may tick up to 5%. So really not very encouraging. And the bank also raising the prospect of a technical recession later this year. I thought it was very significant in the question and answer session that we were listening to earlier. Andrew Bailey did touch on the fact that the bank are monitoring the situation in the Red Sea. We know obviously a lot of shipping is being diverted from there around the Cape of Good Hope in South Africa to Europe, and that is potentially going to add costs to a lot of consumer goods bought here and in Western Europe, and that is something that's clearly very much on the minds of the Monetary Policy Committee. They have, however, removed the language in the statement that talked about having a tightening bias, but they're not really rushing to a loosening bias yet. And accordingly, the market reaction has been very, very interesting. This has been seen, Jane, as largely a quite hawkish statement from the Bank of England compared with what we were expecting. Accordingly, sterling, the pound was nearly 0.5% lower against the US dollar and a third of 1% lower against the euro this this morning. Well, it's clawed back all of those losses. It's now more or less at break even against both currencies. As I say, it's seen as quite a hawkish statement. And the other point to make is that the market was pricing in a 60% chance of the bank cutting interest rates for the first time in May of this year. Well, the probability that the market's now attached to that is 45%. So expectations of an earlier interest rate cut are slightly drifting away right now. And that is actually worth pointing out, in common with what we heard in the United States last night. The US Federal Reserve was widely expected to cut interest rates for the first time in March of this year. And the Fed really did their best to dispel those expectations last night. It's been a similar communication exercise from Andrew Bailey in the Bank of England this lunchtime.
Ian, thanks very much. Police have said that a woman and her 3-year-old child have suffered potentially life-changing injuries in a chemical attack in South London that injured 9 people. A police manhunt's underway this lunchtime as officers try to track down a suspect believed to have thrown what's being described as a corrosive substance during the incident last